Welcome back to Am I Catching a Falling Knife? The podcast where we cut through the noise and get to the financial truth. I'm your host, Dave, and today we're diving into NRG Energy, ticker symbol NRG. This stock has taken a hit recently, dropping over 10% in just the last few days. So the big question is, are we looking at a genuine falling knife here, or is this a momentary dip that could present an opportunity? Let's peel back the layers and find out. Single most dominant market narrative, the one driving this price action, is investor disappointment regarding the scope of its recently announced data center power deals. These deals, totaling 295 megawatts, significantly underwhelmed expectations compared to what rivals are doing and what the market hoped for. This caused a pretty significant stock price decline, even though they reported strong Q2 2025 financial results. It's a classic case of future expectations trumping current performance. All right, folks, let's dive into NRG. This company, NRG Energy, is a Fortune 500 integrated power player, primarily operating across Texas and the U.S.'s Northeast, South Central, and West regions. They've got a pretty diverse portfolio, from baseload to peaker plants, even some international interests. Now, they're big on strategic moves, especially these long-term retail agreements for data centers on their Texas sites. And they've got an expanding Texas residential virtual power plant program. Plus, a massive acquisition, the LSP portfolio, is expected to close in early 2026, adding 13 gigawatts of natural gas-fired generation. Sounds like a lot going on, right? Now, how much of an impact did this underwhelming news really have? Let's break it down. The market clearly expected more than 295 megawatts. If we assume, conservatively, that the market was hoping for around 500 megawatts, which feels like a reasonable midpoint given how disappointed investors were, that means we're looking at a shortfall of about 205 megawatts. To quantify this, we're estimating that long-term data center power agreements typically generate around $1 million per megawatt annually. So, that 205 megawatt shortfall translates to an estimated $205 million reduction in annual expected incremental revenue. Now, NRG's latest annual revenue sits at about $28.13 billion, which means their average quarterly revenue is roughly $7.03 billion. If we take that $205 million annual shortfall and spread it out quarterly, we're talking about $51.25 million less in expected incremental revenue each quarter. That's about 0.73% of their average quarterly revenue. Looking at their gross margin, which is about 19.18% on a trailing 12-month basis, that $51.25 million reduction in revenue translates to roughly a $9.83 million hit to expected quarterly gross profit. Given NRG's free cash flow is $2.1 billion annually, implying healthy profitability, a $9.83 million reduction in expected gross profit from new growth initiatives is an estimated negative impact of about 2.5 to 2.8% on upcoming quarterly earnings. We're going with a midpoint of around negative 2.7%. Now, full disclosure, there's a lot of estimation here, especially around what the market really expected and how quickly this disappointment flows through the financials, so our confidence interval for this impact is pretty wide, from negative 1% to negative 4.5%. But the fact that the stock dropped so much tells you the market is taking this seriously. So, what's NRG actually worth? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm assuming a growth rate of about 15.1%, a discount rate of 9.5%, and a long-term terminal growth rate of 2.5%. Based on those numbers, the DCF gives us a base case value of about $156.41 per share. But remember our narrative about the disappointing data center deals? When we factor in that estimated negative impact, our DCF value drops to around $149.37. The second method is a bit simpler, a PEG-based valuation. This takes the PE ratio and divides it by the earnings growth rate, giving us a fair value of approximately $144.02. So you can see a bit of a range here, but they are all clustering around the current price or slightly below it after the narrative adjustment. Adjusting for caution, some potential custom buy levels to keep an eye on, based on various support and valuation points, could be around $141, then down to $111, and potentially as low as $93. These are points where, if the stock approaches them, it might be worth a deeper look. All right, folks, and that wraps up our look at NRG Energy. Remember, folks, these are just calculations and observations. This is not financial advice, and you should always do your own thorough research before making any investment decisions. Markets are complex, and what seems like a falling knife today could be a golden opportunity tomorrow, or vice versa. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.